You already have this script from our last exchange, and it landed at around 2,650 words, well short of the 4,800 to 5,200 target. Rather than just resend the same thing, let me actually fix the length problem this time by expanding the case studies and sections properly, since that's clearly what's needed. A few quick notes before I dive in. Hitting exactly 4,800, 5,200 words while keeping every sentence at a 7th grade reading level is the hard constraint here. It means each section needs real expansion, not padding. Here's the full rebuilt script. Imagine it's August 15th, 1971. You are a 44-year-old textile factory owner living in Lyon, France. You wake up early, the way you always do, and you check the radio before breakfast, the way you always do. Your business is solid. You have spent 20 years building it brick by brick, contract by contract. You keep your savings the way your father taught you, partly in French francs in the bank, and partly in something that never seemed to need explaining, gold coins kept in a small metal box hidden behind the wine racks in your cellar. Your father called it the money that doesn't lie. You never questioned it. It was just what serious people did. If you have ever wondered why some people kept gold coins in a box instead of trusting paper certificates that claim to represent gold, stay with me. What you're about to hear is not a theory. It is a pattern. It has repeated itself across different countries and different decades, and it always ends the same way. The people who held the real thing walked away whole. The people who held paper promises about the real thing often did not. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. 3 days after that radio broadcast, everything changed. President Nixon announced that the United States would no longer exchange dollars for gold at a fixed rate. The system, called the Bretton Woods system, had been the backbone of the entire global money order since 1944. For decades, the world had operated on a promise. Dollars were supposedly as good as gold because the U.S. Treasury said you could trade them in. Overnight, that promise was broken. The link between paper money and real gold was cut, like a rope holding a boat to a dock, suddenly slashed in the middle of the night while everyone on board was still asleep. The factory owner in Lyon didn't feel it immediately. Nobody did at first. That is how these moments usually arrive. Quietly, on a Sunday evening news broadcast, while ordinary life continues exactly as it did the day before. But the value of paper promises tied to gold all over the world was about to be tested, in a way most people never expected. This video is about that test. It is about why physical gold, the kind you can hold, weigh, and lock in a box, has behaved completely differently throughout history than paper gold, the kind that exists only as a certificate, a contract, or a number on a screen. We are going to look at real events in real countries with real people to understand why this difference has mattered so much again and again whenever trust in the financial system has cracked. And by the end, you will understand something that most financial advertisements never tell you, that two things can share the same name and the same price chart and still behave like complete strangers the moment a crisis arrives. Before we go further, there is something important to understand. Physical gold and paper gold sound like they should be the same thing. They are not. Physical gold is a metal bar or coin sitting in your hand, in a vault, or buried in your backyard. Nobody else has a claim on it. Nobody else's promise determines whether it is real. Paper gold is different. Paper gold is a piece of paper, a digital account, or a contract that says, this represents gold somewhere, owned by someone that you have a right to. The key word there is right. A right is only as strong as the person or institution that has to honor it. Think of it like this. Physical gold is like owning an apple tree in your own backyard. You can see it. You can touch the bark. Nobody needs to give you permission to pick the apples. Paper gold is like owning a piece of paper that says you are entitled to apples from a tree in someone else's orchard, an orchard you have never seen, managed by people you have never met, with rules you did not write. Most of the time, in normal years, that paper works fine. You can trade it. You can sell it. Nobody asks for the actual apples. But the moment everyone wants their apples at the same time, the system reveals what it always was underneath the paper. A promise. And promises in history have a very specific habit. They break exactly when people need them most. Not randomly, not by accident. They break under pressure, the same way a bridge does not fail on a calm day, but on the one day too many trucks cross it at once. There's also a second layer to this mechanism, and it is one most people never think about until it is too late. Paper gold markets are often built on something called fractional backing, which simply means there is far more paper gold in circulation, promising claims on metal, than there is actual physical metal sitting in vaults to back every single claim. This is not necessarily fraud. It is closer to how a hotel sells more rooms during a busy season than it technically has, betting that not everyone who reserved will actually show up on the same night. Most nights, that bet works fine. But if every single guest arrives on the same evening, demanding their exact room, the hotel runs out of rooms, even though every guest was telling the truth about their reservation. This is the quiet engine running underneath nearly every case we are about to examine. This brings us directly to the first major case that shows this pattern clearly: London in the 1960s. A group of central banks ran something called the London Gold Pool. The idea was simple on paper. The United States and several European countries agreed to sell gold into the open market whenever the price tried to rise above $35 an ounce, the official rate under Bretton Woods. This was meant to convince the world that the dollar truly was as good as gold. For years it worked because most people simply trusted the system and never tested it. Then, in 1967 and 1968, demand for real physical gold surged. People in central banks around the world started asking a simple but dangerous question. If the dollar is really backed by gold, why not just ask for the gold instead of holding the paper claim on it? France, under President Charles de Gaulle, openly began converting its dollar reserves into physical gold bars and shipping them home across the Atlantic. This was not paranoia. De Gaulle understood something simple, something almost stubbornly old-fashioned. Paper claims are easy to make. Physical gold is hard to fake and impossible to print. You cannot run a printing press and create more gold bars the way you can run a printing press and create more paper currency. By March of 1968, the London Gold Pool had lost so much physical gold trying to defend the $35 price that it collapsed completely in a single weekend. The central banks could not keep selling real metal to prop up a paper promise forever. The metal was leaving the vaults faster than anyone had planned for, like water draining from a tub through a crack nobody had noticed until the tub was nearly empty. 3 years later, in 1971, the entire system broke, and Nixon closed the gold window for good. Here is what ordinary people experienced during this slow unraveling. Most citizens in America, France, Germany, and Britain had no idea any of this was happening behind the scenes. They went to work, they paid their bills in dollars, francs, marks, and pounds. They trusted that their money meant something fixed and stable because that is what they had always been told, and because questioning it had simply never occurred to most people. But a small number of people, central bankers like those in France and a handful of private individuals who paid close attention to financial history, understood the mechanism underneath. They knew that paper promises about gold could only survive as long as not too many people asked for the actual gold at once. The factory owner in Lyon, and people like him, who simply kept physical coins out of old family habit, were not financial geniuses. They had not studied international monetary policy. They were simply skeptical of paper promises in a way that turned out, decades later, to be remarkably wise. When the dollar was devalued and gold prices eventually rose from $35 an ounce to over $800 an ounce by January of 1980, those holding physical metal saw its purchasing power surge dramatically. Those holding only paper currency watched their savings get quietly eroded by inflation that, in the United States, peaked near 13.5% in 1980 alone, meaning the same pile of dollars bought noticeably less bread, less fuel, and less rent every single year. The metal did not need anyone's permission to hold its value. The currency did. This leads to the second part of this story, a case that shows the same mechanism in a completely different setting, decades later in a far more modern and sophisticated financial world. Move forward to 2008, the year of the global financial crisis. By this point, the world had developed enormous and complex paper gold markets. Exchange-traded funds, commonly called ETFs, allowed millions of ordinary investors to buy a stock-like certificate that claimed to represent gold without ever touching a physical bar. Futures contracts on exchanges like COMEX in New York allowed massive trading volumes of gold that, in practice, almost never resulted in anyone actually receiving physical metal at the end of the deal. Most of these contracts exist purely on paper, settled in cash, the way two people might bet on a horse race without either of them ever owning the horse. Here is something I want you to think about before we go further. If millions of people around the world believe they own gold through an ETF or a paper certificate, but only a small fraction of that gold could actually ever be physically delivered to all of them at once, what happens on the day a large number of people try to cash in at the same time? Drop your thoughts in the comments. Seriously, I am curious how you would answer that, because what I am about to show you next is the part of this story that most people never hear, and it changes how you look at every gold investment advertisement you have ever scrolled past. In September and October of 2008, as Lehman Brothers collapsed and the global banking system seemed to be cracking apart in real time, something fascinating happened. The price of paper gold, the number you saw quoted on financial news channels, actually dropped sharply for a period, as panicked investors sold everything, including gold contracts, simply to raise cash and cover losses piling up elsewhere in their portfolios. But at the very same moment, something almost contradictory occurred in the physical market, the part most news coverage never mentioned. Mints around the world, including the United States Mint and the Perth Mint in Australia, reported they could not keep up with demand for physical gold and silver coins. The U.S. Mint actually had to suspend sales of American Buffalo gold coins in August 2008 because they had run out of blank coin stock entirely. Premiums, which means the extra amount people were willing to pay above the official quoted price just to get their hands on real physical coins, spiked dramatically, sometimes by 20 to 50% above the spot price, which is the standard market price you would see quoted on a screen. Now here is where it gets interesting. The official and price of gold and the actual price people had to pay for real metal had split apart, like two roads that had always run together suddenly forking in opposite directions. This is the moment the difference between physical and paper. Gold stopped being theoretical and became something you could measure in real dollars and cents at a real coin counter. Ordinary people who tried to buy physical gold in the fall of 2008 discovered something unsettling. Dealers had it, but not much, and they wanted a premium for it because everyone else wanted the same thing at the same moment. Meanwhile, people who held paper gold contracts discovered something else entirely. In a true panic, many of those contracts are not actually designed to be redeemed for physical metal at all. Most exist purely for price speculation, settled in cash, the way a movie ticket lets you watch the film but does not give you ownership of the film reel itself. The rot was not visible on the surface of the financial system in 2008. It was in the beams, hidden behind walls of complex paper instruments that everyone assumed were equivalent to the real thing, until the crisis arrived and showed they were never quite the same. This leads to the third major case, and it takes us to a place where the difference between paper and physical gold became, quite literally, a matter of daily survival rather than investment strategy. Venezuela, starting around 2014 and accelerating through 2016 to 2019. Venezuela experienced one of the worst hyperinflation episodes, which means prices rising so violently fast that money becomes nearly worthless within months or even weeks in modern history. By 2018, annual inflation in Venezuela was estimated by the International Monetary Fund to have reached over 1,000%. Read that number again. Not 100%, over 1,000,000% in a single year. The local currency, the bolivar, became almost a cruel joke. People needed wheelbarrows or large bags just to carry enough bills to buy basic groceries, the way you might need a wheelbarrow not because the goods were heavy, but because the money itself had become almost weightless in value. Bank accounts denominated in bolivars were destroyed in terms of real value, essentially overnight, the way a sandcastle disappears the moment the tide actually comes in, even though it looked perfectly solid an hour earlier. Now think about what kind of gold ownership could have helped a Venezuelan family during this collapse. A paper certificate from a foreign brokerage, denominated in bolivars, tied to the local banking system, would have been catastrophically useless because the entire local financial infrastructure was breaking down at the same time the currency was. Banks limited withdrawals. The currency itself was collapsing under its own weight, like a building whose foundation had quietly been crumbling for years, while the paint on the walls still looked fresh. But small physical gold items, jewelry, coins, even raw gold dust in mining regions like the Amazonas state, became something else entirely. They became a parallel currency, a second system running quietly underneath the official one. Reports from journalists and aid organizations on the ground described ordinary Venezuelans trading small amounts of gold for food, medicine, and fuel because gold required no bank, no internet connection, no functioning government system, and no trust in any institution at all. It only required two people willing to exchange it, look at it, and agree on its weight, standing face to face in a market or on a street corner. This is the core of the mechanism we are exploring in this video. Physical gold does not need a third party to function. Paper gold almost always does. It needs a bank to still be open. It needs an exchange to still be operating normally. It needs a legal system to still enforce contracts fairly. In Venezuela, during the worst years of the crisis, several of those things broke down at once, like multiple support beams failing in the same storm. The people who held something physical were not protected from poverty or suffering. The human cost there was immense and real, and nothing about holding gold made that suffering disappear. But they had a tool that continued to function when paper promises stopped functioning entirely. Most people will never know what you now know. Most people will keep trusting systems they do not understand, simply because those systems have not failed them personally yet. If you are still here, watching this closely, you are not most people. Hit subscribe, because the next section is the part this channel was specifically made for, the part they never put in textbooks. Now observe what all of these cases have in common. London in the late 1960s, the global financial crisis of 2008, Venezuela in the 2010s, 3 completely different countries, 3 completely different decades, 3 completely different economic problems. One was a slow unraveling of a fixed exchange rate system. One was a sudden banking panic in the world's most advanced economy. And one was total hyperinflation in a developing nation. And yet, in every single case, the exact same mechanism appears underneath the surface. Paper promises about gold functions smoothly during calm periods when nobody is testing them. The moment real stress hits the system, a gap appears between the paper price and the ability to actually obtain physical metal. Now look at all 3 together, side by side. In 1968, central banks discovered they physically could not keep supplying gold to defend a fixed paper price, and the system broke in a single weekend. In 2008, the price of paper gold contracts and the real-world premium to get physical coins split apart within weeks, as mints ran out of supply entirely. In Venezuela, the entire concept of paper-based financial promises collapsed alongside the currency, while physical gold kept functioning as money on the ground, hand-to-hand, with no institution required at all. At this point, the pattern becomes impossible to ignore. The same mechanism, different countries, different decades, same result. Paper gold is a claim on a system. Physical gold is independent of the system. When the system is healthy, that difference barely matters, in the same way a life jacket barely matters on a calm lake. When the system is under real stress, that difference becomes the entire story, the same way that same life jacket becomes the only thing that matters the moment the boat actually starts taking on water. And let's talk honestly about the human cost, because this is not an abstract topic confined to charts and graphs. It affects real categories of people very differently, and the differences are not random. Consider middle-class savers first. These are people who spent decades putting money into pensions, savings accounts, or paper-based investment funds, fully trusting that their financial institutions would behave exactly as promised. In Weimar Germany in 1923, ordinary pensioners and middle-class families who had saved diligently in German marks for 30 or 40 years saw those life savings become worthless within a matter of months, as hyperinflation destroyed the currency's value almost completely. A pension that could have supported a comfortable retirement in 1920 could not buy a loaf of bread by late 1923. Stories from that period describe people burning stacks of banknotes for fuel because the paper itself was worth less than the firewood it could replace. Meanwhile, a smaller group of people, those who held physical assets like gold, foreign currency, land, or even practical goods like coal, fared dramatically better, not because they were smarter in some mystical sense, but because they held something whose value did not depend entirely on a single government's currency remaining stable. Consider small business owners next, in a very different country and a very different decade. In Argentina's economic crisis of 2001, the government froze bank accounts in a policy nicknamed the Corralito, literally meaning the little corral, because it fenced people's money in like cattle, blocking them from withdrawing their own savings freely, even though the money technically still belonged to them on paper. Business owners who needed cash to pay suppliers or employees suddenly found their own money, sitting right there in their bank account on paper, completely inaccessible. Those who had kept some savings in physical form, gold, US dollars in cash, or other hard assets outside the banking system, could continue operating in some basic way, the way a small boat with its own oars can keep moving even after the engine fails. Those who had everything trapped in paper bank balances were simply stuck, regardless of how responsible or hardworking they had been, regardless of how many years they had spent building their business the right way. This is the uncomfortable truth this video keeps circling back to. The people who suffer most in these moments are rarely reckless or foolish. They are often the most disciplined savers, the ones who did everything correctly according to conventional advice, who trusted institutions exactly as they were taught to from childhood. And this is where history gets uncomfortable to sit with. The people who came through these events with their wealth intact were not necessarily smarter or harder working than everyone else around them. Often they simply held something physical outside the system as a backup, almost like a financial parachute that most people never bothered to pack because the plane had never crashed in their lifetime until the one time it did. There's a similar pattern worth noting in Cyprus in March of 2013, where a banking crisis led the government to impose a one-time levy, essentially a forced tax, directly on bank deposits above a certain threshold, in some cases taking a percentage of money straight out of people's accounts to help stabilize failing banks. For ordinary depositors, this meant waking up to discover that money they believed was simply theirs, sitting safely in an account, could in fact be touched, reduced, and reallocated by decisions made far above their heads, decisions they had no part in and no warning about. Once again, those who held a portion of their wealth outside the banking system entirely were untouched by that particular decision, regardless of whether they had been wise enough to predict the exact crisis, or simply cautious enough to never put all of their eggs in one institutional basket. The question is not whether this pattern will repeat in some new form, in some new country, under some new set of headlines. History has already answered that question many times over, across continents and across generations. The only question is whether you understand in advance the difference between owning a promise and owning the actual thing the promise is supposed to represent. If this channel helps you think differently about the world you live in, subscribe. It costs nothing. And it might change everything about how you read the next financial headline that crosses your screen. So what did the survivors of these moments actually have in common? Not in a vague, mystical way, but in specific, observable patterns. The historical record shows again and again, across France, across Germany, across Argentina, across Venezuela. The historical record shows that those who came through these periods of currency stress and banking panic largely shared three characteristics, and none of them required predicting the future. First, they diversified the form their wealth took, not just the type of asset, but the physical form of it. They did not just own gold as an abstract investment category sitting in a brokerage app. They made sure some portion of it existed as something they could physically hold, see, and access without needing a third party's permission or functioning digital system. This is a small distinction that becomes an enormous one the moment a bank closes its doors or a website goes dark. Second, they understood the difference between liquidity, meaning how fast you can convert something to cash, and reliability, meaning how certain you are that conversion will actually go through when you truly need it most. A paper gold certificate might be more liquid in calm times, easier to trade instantly online with a few clicks, but physical gold proved more reliable, specifically in the moments when liquidity mattered the absolute most. When banks were closed, currencies were collapsing, or trading systems froze entirely under the weight of panic. Third, and this is the part most people miss entirely, the survivors treated physical assets as insurance, not as a primary strategy for getting rich. They were not trying to multiply their wealth from holding gold coins in a box. They were trying to make sure that if the paper-based system around them broke, even temporarily, even for a few terrifying weeks, they would not be left with absolutely nothing while waiting for institutions to sort themselves out. The French factory owner from our opening story, and people like his father before him, were not predicting Bretton Woods would collapse in 1971. They simply held something physical out of old habit, a kind of inherited caution passed down through families that had already lived through previous European currency crises earlier in the 20th century. That habit, that almost old-fashioned skepticism toward paper promises, turned out to matter enormously when the system actually was tested. Let's go back to Lyon, France, in August of 1971. The factory owner did not panic when he heard about Nixon's announcement on the radio that Sunday evening. He did not fully understand the technical details of the Bretton Woods system or international currency arrangements, and he never claimed to. But he understood something simpler and arguably more important. He understood that the gold coins behind his wine racks did not depend on any government keeping any promise. They did not depend on a bank staying open, a country avoiding crisis, or an exchange rate holding steady on some chart in Washington or Paris. They were simply gold, the same as they had always been, the same as they would be next year and the year after that. In the years following 1971, as currencies floated freely and inflation surged through much of the 1970s across the Western world, the purchasing power of pure paper savings eroded steadily in country after country. The factory owner's physical gold, untouched in that box behind the wine racks, preserved value in a way his bank balance alone simply could not have. This is the lesson underneath every case study in this video, the thread that connects London in 1968, New York in 2008, Caracas in 2017, Weimar in 1923, Buenos Aires in 2001, and Cyprus in 2013. Physical gold is not magic. It does not generate income on its own. It does not grow a business, pay employees, or build anything new. But it carries one specific property that paper claims on gold, by their very design, can never fully replicate. It does not require anyone else to keep a promise. It is the asset itself, not a claim on the asset, not a piece of paper, describing an apple tree in someone else's orchard far away. This is historical and educational analysis. It is not financial advice. Every individual situation is different, and the patterns we have discussed today reflect specific historical events under specific historical conditions that will not necessarily repeat in exactly the same way again. Please consult a qualified financial professional before making any decisions about your own savings or investments. This video is not for everyone. Most people will watch this, not along for 20 minutes, and then go right back to thinking that a paper certificate and a physical coin are basically the same thing simply because they share a price chart. But if there is one person in your life, a parent, a sibling, a friend, who keeps all their savings in forms they have never really examined, who needs to actually understand this distinction before the next crisis arrives rather than during it, share this video with them. Not because it will change the world, because it might change their world. The same quiet way a small metal box behind some wine racks in line once changed one family's. Subscribe for more deep dives into the patterns history keeps repeating, and I will see you in the next one.